You as an income producing asset, you are going to be totaled one day. Why would I take out a loan to borrow my own money? Well, I'm not. I'm borrowing the insurance company's money.
This isn't something where you have to pour a mountain of money into unless you want to. You can get started with a very small amount of money.
We believe that a whole life insurance is the best environment to warehouse that money and to flow it from and back to. One thing we never want to do is make implementing the infinite banking concept feel like a burden to your financial life. It should be a blessing. And the first place that should start is
Welcome, everybody, to our first public strategy session of 2026. We're still kind of getting familiar with the Riverside platform here. I'm kind of looking around to see if I can find... Oh, there's the chat. Okay, here's the chat. If you guys wouldn't mind, we'd like to just double check and make sure that our audio and video is coming through. Would you enter a 1 in the chat if you can see us and hear us? Okay. Just the number 1 would be fine.
Got a 1.
Joe Withrow entered the number 1, so that's good. Maybe I have a doppelganger. Is it anybody else? Can anybody else confirm that we're... Okay. Well, Brian can confirm too. Great. Well, we won't belabor the point then. I see another Joe Withrow in the chat. It's like Agent Smith in the Matrix. Like they just keep multiplying.
Is everybody in the chat Joe Withrow somehow?
I don't know. I really don't know. You know what? I sent out, I think by email, I sent out the link that you guys sent to me. So maybe that was tied to my email address somehow. And then everybody's Joe Withrow. Oh, that's hilarious. I bet that's what it was. That the link must be tied to the email that registered. And so I just sent out the same one that came to me.
So everybody in here is registered as Joe Withrow.
Oh,
this is awesome, man. We're gonna have
we do have somebody different. Okay.
We're gonna have a phenomenal economic talk if it's all Joe.
Oh man, this is great. Well, thanks everybody for joining us. I'm really excited. I'm Joe Withrow of the Phoenician League, and I'm coming at you from my solar shed here, way out in the mountains of Virginia. And I always bring that up because I know the lighting's a little quirky, and I've got the exposed beams here, so it's not a professional studio by any means, but it's functional. Runs completely off solar power, which is great, except for when there's snow and ice. So the solar shed, the solar system's actually been off duty this past week. We've had a bunch of ice up here in Virginia. So I'm running this thing off little Jackery external batteries, but I really love these devices. They work really well. So I'm just pleased to be here. We're joined by the Remnant Finance team, which is Brian and Hans here, who we did a session right before the holiday as well. I almost said holidays, but then Hans would get after me. So I made it singular. So, guys, how we doing tonight?
Doing well, man. Very well. Excited to chat about whatever it is that comes up here in the chat or with you. I'm looking forward to it.
Yeah, that's great. I'm just really appreciative of your time. And what I thought we would start with today was just kind of an in-depth overview of the infinite banking concept, the principles of IBC, which is max funded life insurance. It's setting up strategic life insurance policies, but not for the life insurance. It's more a cash warehouse mechanism. And the bonus is that you do have some life insurance death benefit that you can then get creative with estate planning. But when we talk about whether it's max funded life insurance, whether it's IBC, I've heard people call it banking on life, whatever it is. This principle, it's about creating a cash warehouse management system. And it's very powerful. We've been doing it for quite a while now. And we've actually used our IBC policies for various either investments or acquisitions. We can talk about all that. But Brian and Hans, Remnant Finance here, these guys are the professionals who make it all happen. I know just enough to be dangerous. I understand kind of the fundamentals, the basics, and the philosophy, but they do it. This is their business every day. And so, guys, would you mind kind of walking us through? And let's say that somebody has no experience with IBC, has not heard of this before. Can we start at that level and just kind of walk folks through what this is, and then maybe go deeper from there?
Yeah, let's
Right
do
on.
it. So
Yeah.
yeah, so let's start from some very basics here. A few things that we want to take into consideration before we think about this. What we are purchasing in doing this is the asset that is whole life insurance. Now, like Joe said, it's not specifically for the death benefit. If you just want a whole life policy, I mean, we can do that for you, but we're not, it's not really what we do. We're specifically structuring policies using a combination of different types of premium within the same policy in order to optimize this policy. Now, what are we actually talking about here? When we go through our financial framework, our order of operations is protect, save, grow in that order. Each of those can be undone by the prior one if that is not in order. If you don't have a proper emergency fund, you can disrupt those investments. Even if you have a proper emergency fund, if you don't have the protection in place, i.e., you die early, you become disabled and can't earn income, the liability, anything like that, there are a lot of things on the protection side which you could group into any asset or a skill you have protecting that should come first, and then the savings, and then the growth. But we can optimize the protection and the savings components with one asset here. Now, it's not the only protection that we have, because that doesn't necessarily protect us against disability fully. I mean, we have some disability protections within the asset, within the life insurance contract, but not full disability, not full liability. And so we use it to optimize those, but it's not the only savings vehicle. It's not the only protection vehicle, but it is the best for those two. And then when I draw this out with clients, I draw a wall between the P and the S. I draw a line straight up, and then the G. The G, your risk, your investments, your growth assets should never impact or diminish or lessen your principal, your protection, and your savings components, right? And so how do we use the protection and savings to leverage into the growth? And that's where we get into the more advanced strategy. But without really going into much detail beyond that, it's just understanding, applying for, getting approved for, and then utilizing a whole life insurance contract in order to protect, save, and then indirectly grow in the most effective manner. So that's sort of the very bare bones. What is IBC? It's the understanding the flow of capital in, the flow of capital out, how to manage that. Brian, what else you got on that very high level?
I would say also inside of that is the big part. Infinite banking concept is taking over the banking function in your life. So what most people do is they warehouse their dollars at the bank or at some subsidiary of the bank, for example, and they utilize the bank for all the things they're going to finance in their life. The easiest one that almost everybody in this space talks about, and for good reason, because every adult typically goes through this, is purchasing cars. So, we save in the bank, they give us a pittance. They use that money to deploy elsewhere and make a lot of money. And then if you don't want to tap into those savings, we go right to the bank to get a loan at an even higher interest rate, which is also partially based on our savings, that they're able to do that. And we just flow our money back to the bank. So the bank is always profiting. The bank is always getting the interest rates on that and the benefits of storing the dollars. So when you think of all the things through your life that you've used a bank for, all the things you finance, once we put that protection, that savings model into place in a whole life insurance policy, with a mutual company, now we're going to look at how to first, one of the most primary things is how do we take over the banking function? How do we stop using the bank to enrich them when we can solve the same exact problems through a policy? We can warehouse the money. We can borrow against it. We can leverage it. We can pay it back. We can earn the interest, and we can get that tailwind of interest. And that alone can be extremely profitable. Like the average, to stick with the car decision, the average person drives about 13 cars in their adult lives, or let's say from 18 until 70 something, whatever that works out to be.
Till the kids take the car keys away.
That's right. And you probably have $500,000 flowing through your life, into your life, and right back out to pay for those 13 cars throughout a typical lifespan. What if we could just find a place first to store that money and then do the exact same thing? And that's what we're doing. So instead of $500,000 flowing from income, from W-2, wherever you get it, going right back out the door to pay for these things that only makes the bank richer, we warehouse it first, protect the principal, provide a level of protection, and then use that same money to do the same exact thing, except we benefit. So huge part. It's the protection growth. And all of that falls in that protection and savings aspect of the protection savings growth. So very high level there. I don't want to get there, not too many details there, but Joe Withrow has a question.
Yeah, just to make that kind of clear, when Brian's talking about flowing money, most people, I think, when you think about buying life insurance, you think about, oh, I've got to pay a premium, and you think about that as an expense, and the expense buys you the life insurance coverage. That's not what this is. With policies that are structured according to IBC principles, when you make your life insurance premium, you pay the premium each year, it grows your cash value. And you very quickly get to the point to where your cash value is growing faster than your premium. So, for example, let's say you have a policy that's $5,000 a year. You get to the point fairly quickly that you make that $5,000 premium payment. All of a sudden, you have more than $5,000 in extra cash value available to you that you can utilize for any reason. So now, if you wanted to finance a car, for example, for Brian's example, or anything else, it doesn't matter. You can always flow that money out of the policy and into whatever you want. So you flowed the money in, now you can flow it out, and then you can continue to pay the money back in. You're going to continue to build cash value as you make premiums, and so it's just a management system, and it's doing the banking function. It is doing what banks do, except you're taking control of that operation.
Yeah, at a base level, if you think of what banks do, and coming back to the banking function, I leave my money in an account and I make 3%. Brian goes to the same bank and borrows it at 6%. If we say, what's the difference there? You might say 3%. That's the spread between what they're paying to me and what they're charging Brian. But the actual net return on that for them would be 100%, because every dollar they give to me, they're collecting 2 from Brian. That's exactly, and we'll walk through an example later, because one of the questions that asked was, are you suggesting we borrow from the life insurance policy if we need cash? What happens if we don't pay it back? Once we get beyond kind of the bigger picture and get a little bit more into the weeds, this is something that we can walk through, and I can just pull up a diagram real quick and run through it. It's pretty intuitive when you understand it, especially if you start thinking through the mindset of you're getting interest in some manner from a bank, and you're also paying interest to other banks, and the difference there is what we want to capture. So just again, keeping it at the very high level of what is the banking function. Another concept that we want to consider before we really dive in is your human life value. When we look at, if you list all your assets, right, every single person, just mentally, real quick, spend 10 seconds as I'm talking and list all of your assets in order, right? And I said, what's the most valuable one you have? Maybe you have a paid off home, or maybe you have $250,000 of equity in your home. You might have a paid off truck. You might have 10 ounces of gold. You might have $500,000 in your 401k. You might have a Bitcoin, whatever you have, you list them all out. If we list them out and say, what's the most valuable one, 9 times out of 10, the most valuable one is not going to be listed there. And that is your ability as an income producer to go and earn however much money you're currently making for your family. And so we can kind of roughly measure that by, if you don't wake up tomorrow, what is your family, those who depend on you, miss out on for the rest of your working career? Easy math here. If you have 30 more working years, you're 35 and you make $100,000 a year, you as an asset are worth $3 million. At least that's how the insurance company would gauge your max insurability. So you, as an income producing 35-year-old making $100,000, are worth $3 million. So you dwarf the paid off truck that you have, the $500,000 of equity in your home. If you don't wake up tomorrow, your family has a home with $500,000 of equity, but they're missing out on that future $3 million. So we want to take that into the mix when we're thinking about how we can do this. Can I go get a $10 million life insurance policy? No, I can't, because I'm not worth that much, unless you are. Most of us, someone's saying they don't hear anything. Can we do a quick mic check?
I can hear you.
You guys hear me?
Yeah, it's audio's coming through for me. If anybody else can't hear, please let us know. But I think it's probably on your end. That's another Joe Withrow. Darn Joe Withrows are everywhere tonight.
Whoever this Joe Withrow guy is, he's like all over the map.
Yeah, a lot of questions. And just if you join late, if you join through Joe's link, it looks like it signed you up. You're in your name as Joe Withrow. You can go in and manually change that.
We're still learning this platform. I just sent the link out that came to me.
Yeah. But so a couple of high points that we're going to put in before we dive in. You have a human life value. You have an amount that you as an asset are worth, and that's what you can insure. When we think of protecting our life with life insurance, we're actually protecting income. right? We're protecting what we are worth. Just like you have car insurance, probably mandated by the state, you're probably not going to statistically total your car. I've had life insurance or car insurance for the entire time I've been driving. I've never totaled my car, right? You certainly have homeowners insurance. Most of us haven't had our house burned down, right? Though if you do, like Joe's brother, you want to have that in place.
Over Thanksgiving. It's
Yeah,
crazy.
but you as an asset, you as an income producing asset, you are going to be totaled one day. So what we want to do in just broad strokes with life insurance is we want to match that guaranteed event of your eventual death with a guaranteed outcome, i.e., the tax-free death benefit being paid to your family. So we're kind of putting in place a lot of things that are bigger picture, because most of what people talk about, once we kind of get in, we understand, okay, I do want to take over the banking function. I am underinsured, right? I'm leaving my family exposed if I don't wake up tomorrow. I understand that I'm a subject to the bank, and I'm enriching them by not having no control over the banking function. We get some of these big picture pieces in order, and then we dive into the mechanics and how we use it, the living benefits, all these things today. And I always want to kind of bring it back to this bigger picture. Like, yes, the death benefit is not, our starting input here, but it is supremely important. And, in our networks today, Brian and I, we just got a message today that one of the guys that's been in our fight, the mandate fight for 5 years now, never met the guy, sent him a few messages, but passed yesterday. We had no idea anything was even wrong, right? And so that can happen. You can be that one person. And so more important than any other asset you have is making sure that if that is you, that your family is taken care of, and the income that you would have earned, you actually earn for them via the life insurance policy. You're basically outsourcing the responsibility if you're not here to earn yourself. And so there's value in just having the policy in and of itself. But again, that's not why we are having conversations. No one's booking calls with us just to get a basic whole life policy. That's where we get into policy mechanics.
And there's a generational component to this too. We're kind of talking from a breadwinner perspective today, but if somebody's older and towards in or approaching retirement, or perhaps if somebody's is not able to get a policy on themselves for whatever reason, you can also set up policies on family members. Children. It works really well if you set them up on young children. So you can get very strategic with setting up policies. You could also do it with business partners. Whoever you have an insurable interest in, even if it's not you, there is the opportunity to establish a policy. Now, of course, that if you're setting it up on somebody else, you don't get the protection on your earnings potential, as Hans mentioned. But it is a possibility, because I know there are people who are in a position where they don't really need the life insurance protection for themselves, but they still could potentially utilize this as a cash management system and potentially help their family kind of establish a family bank, so to speak, by setting up generational policies as well, which is what we've done. I think we all have policies on the kids, don't we?
Oh, yeah.
Yes.
That's one of my favorites.
Yeah, because they work so much better. Not that the ones on us don't work. The kids just work. I mean, it's phenomenal, the growth.
They got 3 decades of time on us.
Yeah.
Yeah, it's if we list all of the attributes of this asset and didn't give it a name, everyone would want it. And so if we think about, it's not an investment. We never pitch it as an investment. And that is why there is a continuous, a bad rap with this, because it's always, online, it's always compared to an investment. And so why would I put money into life insurance when I could make more in the market? It's like, well, yeah, you can definitely make more in the market. And we do make more in the market. That's not what we're doing here. The question is, when you do put money into the market, where does it come from? Where is it sitting currently? Is it in a savings account? Is it in a seat? Like when you think of your savings asset, your reservoirs, your warehouse for your capital, when you go put it in the market, when you go buy a rental property, when you go buy Bitcoin, whatever you're doing, where is that money coming from? And is it a one-time use when you do that? If I go and purchase crypto, that could be a very wise decision for me to buy Bitcoin and increase my holdings of Bitcoin. But those dollars that you use to purchase the Bitcoin, if they're coming from my savings account, for instance, those dollars are gone and no longer, they're not dollars for me anymore. Now I have Bitcoin, arguably more valuable, but still those dollars are not here to earn for me anymore. And so we're not pitching this as an investment. This is the warehouse for your capital. I kind of view it as a dam. And right now, if you look at your financial situation, you look at your budget, you look at all these income sources, money is going to flow through your life. And I equate it to like a river running through your property. The river runs through, and if you don't do anything, it's all that water that comes in, it's all going to go out, right? You're going to be continuing to make money, and then it's just going to be spent without any intentionality. You could build like a windmill, right, and generate some power from it. That might be putting some money into the market. So you take some of that power of the money that's flowing in and flowing out, and you move it so that you don't have those dollars anymore, but now they're doing something else for you, and they're actually generating power. That's better than just letting it flow in and out. But what if you could build a dam where all the water that comes in is warehouse, is stored, generates power for you, that potential energy, and then you directly control the outflows. In a big picture, that analogy is what I want to create, where every dollar that flows in, it has a guaranteed landing spot where it can grow uninterrupted. It can grow tax-free, and then I can deploy I can use it and deploy it with full control. Like I want all those levers. Right now, I haven't captured every single dollar that's coming in. But notice that in this conversation, we're not talking about this like it's an expense that we're just paying. It isn't. It is something that we fund, right? But we think of this as capitalizing our banking system. We're capitalizing our warehouse where that money's never going to go away. Someone made a great point, another Joe Withrow point here, in response to someone who asked about, are you suggesting we borrow from the life insurance policy? And Joe Withrow asked that, and then Joe Withrow answered and said, one does not borrow from the life insurance policy. The death benefit is collateral for the loan up to an amount close to the cash value. The borrowed funds come from the insurance company's general fund. The policy itself remains intact. That's exactly what we're talking
and it
to.
continues
So
to
great
grow.
job.
Even with you have a loan out, that policy continues to grow as long as you continue to fund it per the contractual arrangement. And so the capital kind of replenishes each year, in a sense, which is kind of what Hans is getting at. If you make an investment out of your bank account, well, your dollars are gone. If you pull the money out of an IBC policy, make that investment, the dollars are going to continue to regenerate in a sense. It's almost like using the same dollars twice because you're getting a rate of return on the dollars inside the policy. It's very small. Nobody's going to be impressed by it, but it's guaranteed and it's uninterrupted compounding. So it's a return there, and you can then take the dollars and also get returns outside of the policy, but you still get the returns in the policy as if you didn't do that, in a sense. And there's some nuances with how insurance companies treat loans. There's some differences there, but I think at the end of the day, it all kind of, whether they recognize loans or don't recognize them, I think it all kind of ends up in the same place, doesn't it?
Yeah. I mean, if you look at all the places where you could borrow money, there is no more efficient asset to borrow from, or no more efficient lending mechanism you can access than a policy loan. We're going to get more into the weeds of this because I know that's what most people want to focus on. But before we do that, I think some of these bigger picture concepts are going to help, because it's basically, once we get to the idea that, okay, this makes sense, I should have this, I want to grow my cash value. Well, then what do I do with it? We jump to the what do you do with it? That illustration helps people realize, okay, now I see the future output. How do I build the cash value? And then that gets even further in the weeds. So not sure how far we're going to get down that track today, but I do think it would be useful to walk through an illustration of how we're actually using a policy loan. Because one of the things you said, Joe, in your emails was that how are we actually, like tangible examples of how we're doing this. So I can give an actual real life example of an investment that I'm doing out of my policy, again, to Joe Withrow's point there, without actually reducing it. So yeah, it sounds like someone is still having audio issues, and I'm not sure, but most are saying that the audio is working fine. So we're just gonna have to press on. But anything else on the big picture, Brian, of like savings rate, human life value?
Assuming most people here, since they're all Joe Withrow,
there's a couple who aren't.
Since everybody on here is Joe Withrow, I'm assuming that most, as we are, Hans and I are in Phoenician League as well, are coming from there, and Joe talks a lot about macroeconomic stuff. And yesterday, I just published. We started a kind of like Hans and I have a long form podcast channel that they tend to be an hour-ish long.
They're excellent, by the way.
Thank you.
Highly recommend. Yeah.
And we decided to kind of start like a little side shoot that I'm primarily doing of more like 8 to 12 minute videos. So it's only got 4 videos so far, this YouTube channel. But yesterday, I don't know if you saw it, Joe, in the email. I talked a little bit about monetary plumbing and the euro dollar. And in essence, if you're thinking about what happens there, it's all based on settlement. It's all based on creating cash by collateralizing assets and then rebalancing the settlement sheets across these ones and zeros across pretty much a big telecommunication network that goes around the world, and rebalancing all that. And so if you've listened to Joe talk about macro stuff, when you take this down to an individual level, we're really just doing that to optimize the use of our dollars in a very similar way, but in a system and an asset that we control. So we build a pool of capital. That's basically what we're going to settle against. We're going to create cash out of that by taking a loan against our policy, against this capital that we've built up in the form of the asset that is life insurance. We turn that into cash via the loan, which is collateralizing that asset. We're going to go deploy that to do the other things we do, whether that's spending, whether that's investing, or whether that's just living on in your later years if you want to just draw that down. But ultimately, through our working lives when we have income, we're going to rebalance that asset. We're going to settle that debt by just refilling that same exact bucket. So it's doing nothing more than what our euro dollar currently does, just on a small scale. So we're taking advantage of the fact that we're in this dollar denominated asset. We're going to be for a long time. I don't believe it's going to zero. So how can I work in that system the same way the bank does, but to make it my benefit? And that's like the big picture of what's really happening here. Building an asset, collateralizing it, using that as cash, turning it right back around and amplifying that over and over and over and over. And it's not an overnight process. That's the difference. The little bit of the difference is the banks have done a lot more manipulation than we can do in this sound asset, where it takes some time. It takes some time to build the capital to start to be able to collateralize it. But on the big picture, I'd say I'm good with that.
Yeah. And just to that point, I want to make it clear though, you can kind of choose your own level of involvement with this. This isn't something where you have to pour a mountain of money into unless you want to. You can get started with, a very small amount of money. You can start building policies, and if you can start with one. You can start with one small one, and a couple years down the road, if you wanted to, you could add another one. And for whatever amount of money you want to commit to as far as a annual premium payment. And so, you could do $1,000 a year if you wanted to, or potentially less. It's, if you want to, it can be highly customized, right?
I would say on the base side, I would say for like a max funded policy, probably as an adult, we have some 18-year-olds who started off pretty strong. It was really impressive how much they got this. But somebody that was, more in the working class, I think our smallest policy worked out to be $400 a month. Wow. And our largest goes into the six figures. Okay. So, they're all over the place, and it's not something that you have to be rich to do, because most of us, hopefully, if you aren't to the place where you can save $400 a month, will get there. Like, that's important. You got to be able to save some money, but that's really what we're doing is we're replacing the saving function, because premium equals your savings. We're turning just what we saved in regular cash, leaving it at the bank, into premium. So that person was capable, which was fantastic. That person started off and got themselves out of debt and was just kicking themselves in gear as a young adult, and was like, I can do $400 a month. And I was like, well, let's start. And they're doing so much better now. It's awesome. So you don't have to be wealthy. The more you put in, the more you're going to get out of it. Now, in all truthfulness, at $400 a month, it's going to take that person, obviously, multiple years. Because if you just think about an average car now, a new car's, depends what you buy, of course, but let's say it's $30,000. That person's looking at a number of years until they can even collateralize their asset to purchase that. But somebody putting $50,000 a year in, who's capable of saving that much, they can get their policies really functional, get past that savings point of having a good emergency fund, and start taking advantage of the opportunities that exist to really expand and grow money. But it goes to scale based on income. This is not exclusive to anybody.
Great.
Now, I think a lot of our questions that we're getting here, I think we can kind of, so a few of them we got. One of them was in the Phoenician League Slack channel. Basically, if I don't have a family right now, I don't have people to support, and we just got another one like that. If I'm not worried about the death benefit, if I don't have people that are depending on me, can I still use this? And the answer is definitely yes. Given that the Fed and the White House have a policy of devaluing the U.S. dollar, how are you mitigating that? And then also the question about, are you suggesting we borrow from the life insurance policy if we need cash? What happens if we don't pay it back? This is a good point. I'm going to jump over to walk through a simple example of a policy loan. I'm kind of skipping to the end here of like if you set up a call with us, we're going to walk through and explain these different types of premium. We're going to talk about your goals, how we're going to structure it to meet your goals. There's a lot of things that get baked in here, but the final product is we have some cash value, hopefully 70 to 80% of your first year's annual premium. So you can do this right away. I'm going to give an example, and I'm going to show you how we're going to take this protection and saving side and then grow it without actually doing the risk there. So let me try to see if I can make this work. I'm going to go to sharing this screen here, and let me know if you see this.
I can see it. I'm not sure about the other Joe Withrows, but this one can see it.
Yeah, can we get a few more Joe Withrows to Roger up if they can see this screen? Okay, we got a yes there. All right, perfect. So what we've got here is we've got a few players in this game, and I'm going to simplify things here. For instance, the insurance company is just going to be one big diamond here, right? But you have your cash value. However you got that, not however you got, but however your policy is structured. At the end of the day, you have a cash value pretty much immediately once the policy goes in force. One of the common critiques of whole life, if it's standard base only whole life, it's accurate, is that it takes a long time to generate cash value, but not the way we structure it. We use different types of premium that generate most of your annual premium in the form of cash value right off the bat. So this is an example from my actual experience and my actual policy. And again, don't worry about if you don't understand the premium mechanics, but I'm just going to show you that I have $35,000 in cash value as soon as I put my policy in force, right? Now, this number represents an untouched amount no matter what I do with this. But what we're going to do here is I have an investment opportunity. The investment opportunity was a real estate syndicate, and the terms of this were 10% a year for 5 years, and then return of principal with an equity stake in the investment, right? So I said I want to put 30 grand into this investment here. So I have a few different options, and I put a few places down here where I could come up with money. I could save up $30,000, transfer it to my checking account, transfer it to the investment, and now I have a rate of return of $3,000 per year, right? I'm gonna make that a little darker. So that's one option. Option two is I could sell stocks, liquidate them, send them to my checking account. I send those to the investment, and now I have the $3,000 per year. I'm gonna make this darker, but my ultimate goal, my end goal here is that with the 30,000
sales.
Right, sure, yeah. So my end goal is this: I want $3,000 coming from this investment. So I could come up with that money from different places. If I sell stocks, yes, Joe's right, I have to pay taxes, and I no longer have those stocks. If I have it in savings, I guess there's taxable on the interest from the savings, but that's pretty negligible. But either way, I don't have those savings anymore, right? I move it from one pocket to another. Now, it's more efficient being in here, but it's not performing the function of saving. So this is on the protect, save, grow. I moved it from here to here, but when I did that, I removed it from savings, right? It's also not doing any protection. So when we think of asset or the different attributes of where money can go, each one's going to have different things they want. The reason I'm moving the money to the investment out of the savings is because in this case, I would rather that money earn $3,000 a year for me than earn 3 cents, right, in a savings account. That's one way to do it. But how can I borrow that 30 grand without actually reducing the source of that capital? And that's where we get into the policy loan. So if we take the insurance company up here, all the premiums from all the policyholders go in. I'm simplifying everything here. Death benefit claims get paid out. Expenses of running a business go out. And over time, they're investing, they're growing this money. So hope that pie grows. But for our purposes, this is just the insurance company's money. We're summarizing the operations of a major 100-plus-year-old business into one single diamond here. And a little sliver of their capital is my cash value here. This is a 100% reserve requirement, right? This is like fully collateralized. This is not an option. I'm not asking to go into underwriting to take out a loan. I'm demanding it because it's a contractual right that I have. So I'm going to say to the company, hey, I have collateral, 35 grand. You have that on hand because contractually you have to. I want to borrow $30,000, but I don't want to do it for my policy because I don't want to reduce the amount that's compounding and earning dividends for me. Right now, before I do anything, I have $35,000 that is generating and that is growing for me uninterrupted, guaranteed, and it's generating dividends for me. So this is my actual policy. This is year one. It's $1 million death benefit. So it is protection. It's also savings. It's also got guaranteed uninterrupted growth. It's tax free, so it's doing a lot of things. But really, it's not doing anything for me on the growth side. Like, it's growing, yes, but in like my high yield savings is not really growing my money. And to answer the question about how are we mitigating the devaluation of the dollar, it's certainly not doing that, right? It's not growing to that tune. But that's not the intention of it. The intention of it is to be a protection and savings asset. So what I want to do is I want to keep this $35,000 untouched. So I'm going to say to the company, I'm going to demand by requesting a policy loan, you're going to give me $30,000 of your money, right? So now the 30 goes into my account. I send it to the investment. And so now I have incurred a loan. I have a loan to the insurance company that's coming that I pay from my account. That's supposed to be red. Apologies, because I want to show that it is incurring interest. It is, in my case, it was a 5% loan at $30K. So I was incurring $1,500 of interest a year, right? Now you can see the math here. When I gave that example earlier, if Brian is taking out a car loan at 6% and I am getting a high yield savings rate of 3%, remember we said that's a 3% spread, but that's a 100% rate of return. Well, in this case, every dollar that I send to the company, I'm collecting $2 from the investment, aka for every $1,500 of interest I incur, at least in the year one calculation, I pay my interest of $1,500. I collect $3,000 from the investment. So I have a 100% rate of return on the interest, which is the cost of capital, right? Now, here's the powerful part of this. Why would I take out a loan to borrow my own money? Well, I'm not. I'm borrowing the insurance company's money. But here's the real kicker is they are not going to give me a repayment schedule on this. What they're going to do instead is they're just going to collateralize $30,000 of my $35,000 of cash value. So there's a lien here for $30K. And if I die the next day after taking out this loan, my $1 million death benefit that would go to my wife, they would make themselves whole and my wife would get $970. So effectively they would say to her, they're not going to actually say this, but they would say, we owe you $1 million. This is your tax-free death benefit from the policy that Hans paid for. However, he asked for an advance, and we gave it to him. Now, we wouldn't let him take an advance on the whole $1 million because that hadn't, quote, materialized yet. But we let him borrow against the present value. This is the future value, right? And the present value was the $35K. We let him borrow against that, and he chose to borrow $30,000 for an investment. And so he didn't pay us back, and therefore we make ourselves whole on the death benefit. So my wife would get the net there. So I've borrowed effectively from the future. But because of this, because of the fact that with certainty, like most of you don't know too much about me, but you know I'm going to die one day. I don't know much about you. I know you're all Joe Withrow, but you're going to die one day, 100% guaranteed, right? And so with 100% certainty of this event happening, there is no concern on me paying back the 30 because they will be made whole. Now, if we think about what comprises an interest rate, it's the time value of money and default risk. So if you're looking to, if two people come to you for a loan and one of them's Joe Withrow and he says, here's how I'm going to pay you back, here's all the assets, and here's collateral that I have. If I default, you get this collateral. And the other person is your 18-year-old nephew who wants to buy video games and he has no job. Well, the time value of money is the same. If you give them each $1,000, the time value of that $1,000 to you is the same. But the default risk is very different. You're going to charge a much higher interest rate to compensate the default risk to your nephew than you would to Joe Withrow, right? Now, there is no default risk here. So the only consideration in this equation for the insurance company is the time value of money. And that's what they're getting compensated for is just 5%, right? So I am paying interest, but because there is no default risk, because it's a guaranteed investment for them, it's the safest investment they can make. Payment is certain, but the timing is uncertain. Because they don't give me a repayment schedule. So I have full control over the repayment of this loan. So what I actually did was I said, I'm going to pay the interest, $1,500 a year, and I'm going to collect the $3,000. If I only do this, I made a 100% return in my first year. If I compare my out-of-pocket cost to get this loan and my investment yield, right? So this is the savings, this is the protection, and this is the growth. This is when we talk about we want our dollars to be doing more than one thing. This is what we're talking about right here. Because I could, had I gone the savings route where I just take savings, I move it to checking, I fund the investment, and then I die the next day. Well, I left my wife with 30K less in savings, and I left her an investment that she doesn't want to manage. If I liquidate stocks, same thing. I leave her a smaller stock portfolio. I do leave her an investment that's generating this return. That's true, but that's what I left her. In this event, by flowing my capital into cash value first, I'm putting it in a situation where the guaranteed growth is uninterrupted, and I would now leave my wife the investments as well as the death benefit. But one more kicker here is that this 30K doesn't reduce the amount that's actually growing the whole time, because I never actually borrowed. And this gets back into the phraseology, I guess, when someone first asked the question, which was, so you're saying I would borrow from my policy? And a very wise Joe Withrow said, you're not borrowing from, you're borrowing against your policy.
Which wasn't
right?
this one. That was a different one.
A different
It was
wise
the
Joe
wise
Withrow.
one.
Yeah, and so this when the 1 year anniversary comes around, I'm getting my growth on this, which is typically 4 to 5%, is about the internal rate of return. I'm getting a tax-free dividend, right? And that's based off of this 35,000 because I never actually diminished it. So this grows uninterrupted, and when I make a payment, all I'm doing is I'm replenishing my capital here. And so let's take a look here. Let's take a different example than the investment. Let's just say it's a car payment. Same thing, same mechanics here. I've got the same cash value, but I want to buy, instead of an investment, I want to buy a $30,000 car. So here's my car. I could do the Dave Ramsey. I could save up 30 grand, move it to the checking, move it to the car. Now I have a car and no cash. I could go to the dealership. I could finance with the dealership. I keep my cash. I pay back monthly. And at the end of the 5-year term, I have a car and no cash, but I've paid maybe 35, 36 instead of, so I paid a little bit more, but I had my money for longer, so I could maybe grow it. But if I take a policy loan, the company, I'm going to send the cash to the dealer, which means unlike a financing from the dealer, I own the car outright. They don't have a lien on it. But now I do have a policy loan here. But when I make these repayments, let's say I've got my 30 here. If the dealership gave me terms, and my terms, I'm totally making up numbers here, my monthly payment was $1,000. Yeah, no, don't do the math like relative to the value of this car. But if it's $1,000 and that $1,000 was going $200 to interest and $800 to principal, well, let's just assume I give myself. Remember, I don't have to pay my policy loan back, but I'm going to choose to, and I'm going to choose to pay $1,000 back to myself the same way I would pay $1,000 back to the dealer. Well, the interest, and again, this is not amortized. So this is like bringing down the power of this to the level of the car loan. It's actually more powerful because the whole $1,000 goes to principal. But even if I mentally pretend that $200 goes to interest and only $800 goes to principal, which is not how it works, it all goes to principal. Even if I assume this, what happens? I can call this a wash. $200 interest goes to the dealership. $200 in interest goes to the insurance company. Again, not quite accurate. It's actually better than that. But if we're assuming that, but $800 going to the dealership is also lost to me, right? I don't get anything back for that. But when I pay my $800 of interest back to my policy loan, what they're going to do is they're going to reduce the lien on my cash value by $800. What does that mean? Well, before, in this example, I had $5,000 of available cash value that I could borrow against. And after I make this loan repayment, if I assume that only $800 went to principal, well, now I've freed up my own cash value to borrow against again. So now my cash value, this asset, this savings, I've increased my balance to 5.8. So it's not that I'm paying interest to myself, but the terms of this loan, it's unscheduled, so there's no repayment required. It's guaranteed. There's no underwriting required. There's no appraisal. There's no what is this for, how you pay us back. So it's guaranteed without underwriting, without a repayment schedule. In reality, all $1,000 goes to principal and pays down. So if I made that $1,000 payment, I would actually increase this to $6K. But just for sake of, apples to apples, I'm trying to make this as bad as dealing with the car dealership. So there's no more powerful vehicle for lending. And so this element of it right here, how does money get into cash value? That really gets into how we structure your policy. We can do that very, very quickly. We can do it just pretty quickly, depending on your goals and what you want. And so to answer some of the questions, does this work if I don't have a family? Yes, because in that case, we don't really even need to worry too much about this element of it. So we can really go all out and optimize for the cash value, right? Now, there is no death benefit, or there's no cash value without death benefit. You have to have a death benefit. It's not like we just can totally neglect that. But if you don't care about the death benefit, well, we just make the policy, we lower our importance of that human life value element and increase the importance of the current present value, i.e. the cash value. So it certainly works for you if you don't have dependents. Now, to the question about the devaluation of the dollar, well, this in and of itself is not really protecting me against the dollar while I'm alive, though it will for when I eventually pass, right? This is the present value, 35K. That's growing, uninterrupted, guaranteed. That's not protecting me against devaluation of the dollar, though. But what's protecting my family down the road is this, all right? And so we're trying to figure out, like, dollars have to reside somewhere. You have money right now, whoever you are listening, you have money, and they're sitting somewhere. They're either sitting in an investment or they're sitting in a savings vehicle, and each of those places where it could be has some attributes we're talking about here. This is not the end all be all. This is not the only asset. This is not even your only savings asset. I have money in a savings account when I want it immediately, right? This is not my only, quote, investment, because it's not an investment. My investments are all out here, right? And so it's just economics is just optimizing scarce resources. So where do dollars flow in when they first enter your system? Where do they reside? Where do they live? And then is that a permanent home for them, or is it temporary? Do they flow in and flow out? And so, yeah, that's a lot right there. So I'll pause. I know we got I don't know who
Yes.
what,
A
who got some questions here,
comment
but
or question. You didn't
yeah,
take into account what you paid for the policy,
yeah,
which, yeah, can
yeah, yeah.
can you speak to that? I mean, I think that's just like when you pay the policy, what you pay in builds cash value. Can you elaborate on that a little bit?
Yeah, absolutely. So yeah, you're right. I am paying for this policy. So what we're saying is I have to come up with, and we'll caveat this. This is year one, right? When we get down the road, and someone mentioned in the comments earlier, my policy's 4 years in. My policy total is a 50K annual policy, and 70% of that, i.e. 35 grand, is the type of premium that generates cash value now. But now by year 4, I put in $50,000 and I generate more than $50,000 of cash value. So it takes, like building a business, it takes a few years to where I deposit a dollar into my savings account, and it grows by more than a dollar. And down the road, 10, 20 years from now, it's growing by 100%. I mean, imagine having
It gets to be
a high yield
incredible.
savings with like 100% rate of return, right? And again, if you don't understand anything about whole life policy mechanics, that's going to sound nonsensical. And that is, if it sounds nonsensical, hop on a call with us. We'll walk you through the actual mechanics, because it's not just like this magic pill. It actually works actuarially once you understand the components. But yeah, I do have to fund this policy. So in this example, let's say I didn't want to do this and I just wanted to take my $50,000 and just put it right into my savings account, and then use that to buy a car or use that to fund an investment. That's fine. I could do that. However, like I said, I now no longer have that 50,000, or in this case, I have 20,000 in savings and I have 30,000 in the investment. At the end of the day, I still have this investment. If I go to my actual examples right now of what I'm working with, I have that actual real estate syndicate. I have 3 rental properties that my cash value has funded, or the insurance company has funded with collateralizing my cash value. And then I'm also doing the low stress options, right? So currently, if I look at my policy, I have 5 different things that are entering, 5 different streams of income that are entering my financial sphere, right? My dollars first go into the policy, 50 grand a year. And so the first year I only have 35. Yeah. In my year one, I'm about 15 grand shy of what I could have had I just gone directly into savings and then into an investment. But what I'm doing is, to me, I know for some of you specifically have said, like, this is not important to me, but this is very important to me. In fact, this is more important than any investment I have, is that my wife and daughters do not change their lives financially if I'm not here to earn for them. I don't want to leave my wife rental properties that I got with Shane Thompson in 3 different states. I love them. I manage them. But I don't want to leave her a property in Pennsylvania and Oklahoma and Indiana. I don't want to leave her a crypto portfolio that she doesn't know how to do. I don't want to leave her options trading that she doesn't know how to do. And so ultimately, for me, the why is this, right? Is the death benefit right here. But in the meantime, very quickly, this was year one, was this investment. And within 4 years, I've got these 5 things here. So I'm still investing. And so it always gets back to compared to what? Okay, yeah, you're not factoring in the cost of the premium. Well, I am, because that's how I fund this. That's where my savings go. If you don't have a cost of the premium, you bypass this and you go directly into somewhere, right, maybe directly into one of these things, but then these dollars have one purpose. I count my dollars as currently having 7 purpose. There's 5. 6 is the continued guaranteed uninterrupted growth plus dividends, and 7, and most important, is that death benefit.
I think we should point out the reason this is so powerful is because this is fundamentally a contract with the insurance company where they guarantee cash value over time. And this is where, if you haven't done this before, you can, if you talk with Remnant Finance, if Brian or Hans or anybody on their team, they can do a policy illustration where it shows you the insurance company is guaranteeing that you will have a specific cash value each year of the policy that you keep it in force. And so there's no guessing here. There's no things that hopefully happen at all. It's guaranteed by contract. And that's why sometimes I refer to this as max funded life insurance contracts, because it is fundamentally a contract. And that's important. So that's how Hans can be so certain that this, as the policy ages, it's going to build more and more and more cash value over time because that's contractually guaranteed. It's going to happen.
Yeah, I mean, always compared to what? Compared to an investment, yes. Compared to other savings, yes. What else are you going to do with your money? To me, the optimal place is these dollars flow in to cash value. They're warehoused, they grow, they compound uninterrupted, they earn me dividends, they protect my wife, they protect my daughters. They're going to multiply many, many times over down the road. And in the meantime, I get to enjoy the usage and access of them without interrupting that growth curve. There's a lot of places I could borrow from, but when I do that, I deplete the principal, and so I'm earning on less. That's not the case here. Imagine, if other things other places where we could borrow money, right? A HELOC, for instance, right? That's a pretty powerful one when you have the equity, but what does it require? If we're listing attributes, well, I'm giving up a good bit of control because I actually don't control whether that note is called or not, right? I don't control a lot of things. I don't control that it's guaranteed. I don't get the full access of it. I get a loan to value ratio. Like, there's a lot of elements that the bank controls. I would love to be a banker that could offer HELOCs. There's a reason that they're a huge industry. They're a good tool for us, yes, but they're a phenomenal investment for banks. Banks love issuing HELOCs. Were there any questions that I missed while I was talking? And also, there should be a way that we can bring people on if you want to, raise your hand and come on the screen and ask questions or chat. I wish we could see all of you, but again, this is a new medium for us.
I haven't clicked this. Let's see. If you click the people thing, oh no, it doesn't really show.
If someone wants to try raising their hand, ask a question, I can see if we're able to add you on screen if you do have a question you want to ask. But yeah, I think that with that walkthrough, if you understand that you have why we love this asset as a way that we can leverage and borrow and then get into growth assets, and you also understand that it itself is not the investment is what you go and do with it.
Yeah.
It facilitates
There's no
that.
either or decision that has to be made.
Right.
You don't have to decide do this or do that. You do this first, and then you do whatever else you want, because you can do them both.
Super powerful.
Yeah.
Yeah, if we got any other questions, there's so much we can cover, but I really want to avoid the weeds. I know Brian likes the big picture. I love the weeds, but I know that we want to make sure that if you have questions about this, that you understand how it plays in with this. And I guess I didn't quite address the devaluation aspect of it. This is a dollar denominated asset. I believe we're going to be continuing to transact in dollars, and I want to have the guaranteed growth. I want to have the certainty. I want to have the guaranteed access, because right now, to me, feels like a phenomenal time to have a lot of dry powder. And if you understand that walkthrough we just did, that cash value is my dry powder to the amount that I freed it up. I can have a policy loan in my bank within a week without underwriting, guaranteed, at a time when banks might be tightening up the purse strings. I can always give you an example that the best personal example I have was a buddy of mine, a client, pays $250,000 of premium a year. Big real estate investor here in San Diego. Yeah, so he's buying a property in Utah, and the bank's giving him the runaround. He's buying a $7 million place in Park City. He brings $3 million to the table. Now, we hear that, and we think that you bring $3 million down on a $7 million property, every bank in the world is going to take that, right? But they said no. They declined the mortgage. And they have about $60 million of real estate. They're a huge client at our local bank here on the island. The bank said no. He said, let me collateralize a house on top. He brought $3 million and he brought a $4 million house as collateral. So the bank is in a win-win. Like there's no bad scenario here. The bank said, no, we don't care about collateral. This was a 6-month process. Eventually he had 3 properties posted as collateral and $3 million on the table, and they still said no to a $4 million mortgage. $3 million down on a $7 million house and $17 million in collateral across 3 different properties. The deciding factor was they wanted $600,000 cash in the bank deposited with a guaranteed hold period of 6 months. That's all they cared about. And that's because we were in a liquidity crunch at the time. They really needed cash now, and that's all they cared about. They didn't care about having to sell $17 million worth of houses, right? Like they didn't care about that. And this sounds crazy to us because we are used to economic truisms, but when banking conditions change, we don't get any say over that. And so that finally moved the needle. He said, I'll put $600,000 in the bank and I'll hold it for 6 months with you and 17 in collateral, and I'll bring $3 million to the table. This is all documented. This was like a working Google sheet we were going through as he's sitting down and negotiating with the senior loan officer at the bank. He said to me, what do I have in cash value and how soon can I get it? What do I have to do? What's the underwriting here? I said, there's no underwriting. It's guaranteed. Here's how much you have. He said, give me a loan for that. 4 days later, maybe 5 days later, it's in his bank. Now, that doesn't move the needle. He had at the time about $300,000 of cash value. That doesn't really move the needle in a $7 million transaction that much, but it was proof of concept to him. He had been doing this for 2 years. It was proof of concept to him. He said, if I had been doing this for 10 years, I would have never even had to go to the bank because I control the terms here. And so HELOCs are great. There's a lot of great lending tools, but when the bank is in control, they are going to profit at your expense no matter what. Even if you get value, right? You get value from a HELOC if you're a real estate, but like we understand the value of a HELOC, right? But they are going to profit for sure. You are going to hopefully profit, but the risk, the maybes are all on your side of the ledger. And so in that environment, that example was so telling. It was a proof of concept. The guaranteed immediate access with no underwriting in an environment where the banks are saying no to even the most generous down payment he was trying to make. The offer, you couldn't build a stronger offer to get a $4 million loan, right? Than that. And so this was a very it was validation of what he was trying to do with this.
Yeah, that's why Nelson Nash titled his book "Becoming Your Own Banker." So Brian, I want to get your I don't know if presentation's the right word, but what you've got worked up. But just in case we have folks. We're at the top, or we're running for about an hour now. So just in case we have folks who have to drop off, if people want to learn more, or perhaps want to chat with you guys over the phone about how this could work for their situation, what's the best way to do that? What's the best way to get more information and connect with you?
Typing it in now. Yeah, you can just check us out at remnantfinance.com/calendar and book with Hans or I there. That'd probably be the easiest way.
And we will release it. Like once we get the video of this, we'll send it to Joe so he can send it out to his network. We'll also be releasing this as our podcast. And so if you have to hop off now, you can still hear the rest as we go through more questions and an example here. But yeah, book with us. And
I was going to say, like you were talking, if you get into more advanced by the way, number one, will the real Joe Withrow please stand up? Number two, who's the Joe Withrow in here that has a very, very good understanding of IBC? Because whoever that is, like your comments are fantastic and your explanations in the comment section. I was just wondering who that actually is. Where they were typing about other people's money.
Yeah,
it is using other people's money for an investment. Yeah. So that's absolutely they've nailed it. They've nailed just about every comment. I'm assuming that's the same Joe Withrow that's getting all the good comments. So. Kudos to whoever that Joe Withrow is.
Yeah, sorry. Next time we do something like this, I'll be sure to not send out a link that makes everybody me.
It makes it more fun.
Yeah, Hans touched on it, like using the investments. So, and I also do the low stress trading like Hans does. And so one thing we can easily do with this is deploy this money out and then earn a lot of money if you're doing well with a particular investment. So that can keep you ahead of the dollar, and that's where we start to really grow. But it's also important to just, Joe, you asked me to mention this, to just having access to capital. Like my family and I just moved to a new house in the first week of April last year. and absolutely gorgeous looking straight out. Like it's basically all farmland behind me. And as far as you can see, there's one house that I'm looking at, and
Nice.
then a farm to the right, and it's just fields. It's gorgeous, right? So we moved into this house, and there was a 5.2 acre little subsection not owned by the farm, but it was just pure pasture fenced in. That was owned by a gas company. Well, that gas company, as I come to find out, was acquired by a larger gas company in December. So the new larger gas company, they didn't keep land holdings as part of their assets. So once they had the 2 years where they could liquidate the land and keep the mineral rights, or the capital gains side of that and everything, they started liquidating it. So 2 months after we move in, this hits the market, and I jumped on it. I mean, it hit the market. My friend saw it on Realtor.com, texted me. It's like 10 o'clock at night, and I start calling the guy selling it. And he's like, I don't usually take calls this late. I was like, I would have called you at 2 a.m., dude. Like, I want this land, and I want to make sure nobody gets it. Well, long story short, the next day he calls me. So we put an offer in first thing in the morning for just under the asking price. The next day he's like, dude, this is a hot property. We've had calls all day. There's 4 other bids, and a couple of those bids were builders. So they came in $80,000 above asking price. They were willing to escalate up to that. I found that out, but the gas company took mine because I had cash available on hand. So where did I get that? I borrowed against my life insurance companies to ensure that my beautiful landscape that I just spent a lot of money on this house on isn't obscured now with 5 to 10 houses in my backyard. And I still preserved that beautiful land as long as the farms never sell in the future. And it was all about access to capital. So I paid $80,000 less than the highest bidder because the gas company said, we like his offer. There's no contingencies. There's no perk tests. There's no zoning. There's nothing. And I said, I can close in a week. He's like, well, we'll do a month so they can do their job. But yeah, so it's not always just about how do I invest this. It's also about, Nelson would always say, cash attracts opportunities, right? So they'll come by you. And what I've realized since I've been doing this for a number of years is that the opportunities used to just blow past you because you don't have a way to take advantage of them. You heard them, but if you don't know what you're listening to and you can't take advantage of it, they just go right by you. You don't really pay attention, and you stand on the side of, I wish I could have. That would have been cool, and then it's gone, and you forget about it. But now here comes this opportunity for me to buy 5.2 more acres right behind my house. I'm sitting on a giant pool of capital that I've capitalized in life insurance policies, and I was able to grab it while underbidding everybody else. It's just that opportunity was only, if this was 15 years ago, I would have said, man, it would have been really cool if we would have had that land and they wouldn't have built those homes back there. So it's not just about how to accelerate your money, although I do believe that's extremely important because we have to stay ahead of inflation. But it's also just about being able to take advantage of opportunities. But I just wanted to show real quick, like what Hans was talking about. I'm not going to dwell on this because it can get in the weeds. But this is pretty close to one of my policies. So I backed my agent. I couldn't find my original illustration somewhere. So I just ran one as a 40-year-old. And this is like almost exactly what it would look like for me now in the 4th year. All right. So it's about a $20,000 policy. So if you look here in year one, this just to illustrate what he was talking about, there is a cost to the insurance. There is a cost to doing this. But in this first year, and this is just the way I set mine up, there are innumerable ways that you can design a policy, and it all comes down to what your personal goals are. But in year one, I had about that much cash flow. You can see it was a pretty decent dividend, and these really aren't that far off. Even a few years later, the dividends, these are a little bit higher than what was originally projected, but it's close enough. So in just the 3rd year of this policy, under the current dividend scale, here's what Hans was talking about. If I paid my $20,000 in premium that year, the cash value increased at the end of the policy year by $20,073. So it's already more than a 1-for-1 very early in the policy. So every year that I do that is just going to get better and better. So here I put 20 in and it increased by 22,462. So if I were to look at just now overall, you'll see that I've paid $100,000. I'm still upside down. I refer to this as the cash drag period of the policy. I'm overcoming these first couple of years where the cost of the insurance and setting this policy up paying the commission to the agent, all the things that happen in the beginning of a policy have to happen in years 1 and 2, and partially 3, sometimes most of the time. I'm still overcoming that, but you can see how that just keeps getting better. 10 years into this policy, I put 20,000 in, and I have that much available to me in the form of cash value, $29,000. That's all, what, about a 50% year over year for the 20. So for the person who, if they're still on, who asked the question way back about staying in front of the devaluation of the dollar. Now, this is a savings environment. This is not an investment, but I'm buying an asset here. We all buy assets and none of us complain that it cost us money. So we're purchasing an asset. But if I look at when I continue utilizing this asset, would you stop me in the world of the devaluing dollar? If I came to your house and I said, "Hey, Joe Withrow number 73, I'm going to knock on your door. Give me $20,000. I'm going to give you $29,000 back." Would that be a pretty good return on your dollar for that particular year? Would you tell me to stop coming because it's too hard to find the premium? Or would you be like, Joe, actually real Joe number one, would you be like, "Dude, I'm so sick of coming up with this 20,000, don't come back"?
Well, I mean, your response would be, "Well, what's the angle, man? What's the hook? That doesn't seem, it doesn't make sense. There must be something going on here that I'm not aware of. It's just too good to be true."
It's just what the value of this future death benefit over time is in the current day. So actuarially, these have to increase every year. Now, if I paid less than 20,000, that's not going to increase by 29,000. And in this policy, I have the opportunity to pay, I don't know, somewhere below 5. I didn't look at it because I just ran this illustration real quick.
That's a good point. If you had like a life experience 1 year and you couldn't come up with that 20K, you could pay less than that for 1 year if you needed to, right? Without
in this particular policy, I could pay a minimum after year 1. I mean, in year 1, it's only $380 more than this, but I could pay. This is the minimum. This would be the maximum. There's a little bit of nuance to that we don't have to get into, and it's a company nuance, so it doesn't matter. But everything in between there, so about $15,000 of that $20,000 premium is completely flexible. I can choose to pay it or not. So if I have a rough year, then I can just pay $5,337. If everything's good, I can pay 19. So that is up to me what I put in there. But if I can think long term and see what those dollars are going to do for me down the road, it's a great place to warehouse that. And this whole time, this is the total cash value. So this is the cumulative column. I've had the opportunity to use all of that. So here's that property that comes available. I can jump on it. Here's an investment. If I don't have current policy loans out, I can borrow against all $200,000. I can be using that from year 1 and recycling. All I'm doing, like I said in the very beginning of this webinar, was we're just going to create something that we can create cash from, leveraging this asset, utilize it, and flow it back in. So yeah, it's just going to keep getting better and better and better and better forever. It can't get worse. It's contractually impossible to get worse.
Let's talk about one element here that we haven't hit on. Generally, I know that Joe has this in his onboarding and his training, IBC. I know that I assume that the general understanding of IBC is fairly decent. But to go back to bare bones, if you're wondering how could I put 20 in and get 29 out, like how does this even make sense? Let's talk about that column that says annual dividend. We're using mutual insurance companies, right? Vice a stock company, where the shareholders of the stock, the owners of the stock, own the company and therefore share in the profits of the company. We're only using mutual companies per Nelson Nash. You can see right there, becoming your own banker, right? Mutual companies where we as policyholders own the company and share in the surplus of the company, right? And so that column there is the dividends, and that is a tax-free return of principal that comes back to us. Now we can do several things with that. You could take that as tax-free income, technically up to your cost basis, but we don't do that. This illustration makes a few assumptions here. One, it has to assume the dividend because we don't know the future, but we know that this company in particular has paid dividends for about 120, 125 years consistently. So one of the criteria before we even work with the company is not only are they mutual, but they paid a dividend for over 100 years. They have to have been profitable through the Great Depression. And so in this case, this dividend specific amount is unknown, but that there will be a dividend is as high a certainty as we can have in anything talking about an uncertain future. Now, the other assumptions here, there's two of them. One is that we pay the illustrated $20,000 a year. As Brian said, you only have to pay 5 and change, but this illustration to get these growth mechanics, if that dividend were exactly what those numbers show, using the current dividend scale, and if you paid exactly 20 grand a year, then the only other assumption made that makes these numbers actually true, actually predictive of the future, is that you take that dividend, and this one is structured that you take the dividend and purchase more death benefit with it. It's called a paid up addition. That generates cash value immediately. And so when I draw this through this with a client, I basically take that dividend, I draw a line over to the death benefit. I say, you're taking that dividend, you're purchasing death benefit. I draw a line back to the cash value. I said that immediately increases your cash value by about as much as the amount of the dividend, the magnitude of the dividend. And if your cash value, remember going back to my illustration, I drew that little sliver to represent your value, your contribution to the company's profitability, right? Well, if I'm growing that every year by my premium, the PUA, that 15 grand that I choose to pay increases my death benefit, and I take that dividend to increase my death benefit. If I'm growing my share relative to the company's performance, I'm increasing my pro rata share of their dividend. And so that's why those dividends continue to increase. And that's why Brian said, if you stop paying that $15,000, all the numbers after that might change. But I just want to address, because you might be looking at that and saying, how could I possibly get 29,020? It's not just that like they're investing and making money. It's all the elements that Joe Withrow, the IBC practitioner, has been saying here, and spot on. These mechanics make sense when you understand them, and that's always my goal with the first call. If you don't understand
typically,
this,
I typically don't even like to go through this on a first call, but I just wanted to illustrate, because it's really hard for somebody to hear what you said. You put $1 in and you get more than that available when you said that. And I just wanted to show like that the illustrated values are that. I start this off with every call and say, just so you know, this is an illustration. Every single number on this page is wrong. That's the very first thing I tell somebody. It's a projection based on a whole bunch of things. It's a projection based on, first off, these are non-guaranteed. These are based on the current dividend scale. That's going to go up. That's going to go down. It's predicated on you doing exactly what this says. This half of it, it's calls the guaranteed side, and it is the guaranteed side, but it's assuming that it never, ever, ever pays a dividend. And it's also assuming that you paid the full $20,000. As soon as a dividend pays, it becomes part of the guaranteed side. So soon, and this company in particular has paid a dividend for like 18 years straight since its inception, something like that, 120 years. But so it's pretty high probability they're going to pay a dividend. They always have. They never haven't. So as soon as that happens, notice the difference in these two cash values. This one is showing zero dividend. This one is showing the dividend included. So if that pays, this number would be transposed here, and then every number after that would be drawing the assumption that there's never again a dividend, but it's starting from a higher value. So that's why everything's wrong. And then over here, this is going to change. And probably at some point, this is going to change your behavior, which is going to make everything over here wrong. However, it's a great projection of if your behavior matches the plan, it's going to pay this dividend. It's going to increase this death benefit, like Hans is saying. That's going to increase this cash value, and on and on and on. And oh, by the way, after 6 years, if you really hit hard times, Joe, to answer your question, the dividend is large enough that it could pay the premium for you, and you could turn this policy into a self-licking ice cream cone until your situation gets better. So if you had to turn it off and say, hey, I want to use all my dividends just to pay the premium and keep this in force and just be able to sit back until life stabilizes, it would only take you 6 years to be to that point and not have an outlay and not feel like you have a bill when the world's crushing on you. So there's so much option, freedom,
it's
control.
that flexibility that is so attractive. You don't get that with other assets.
I just want to answer this question. So don't you have to pay back that loan over time? Since there are no payment schedules, is it just about how much you want to pay in interest over time? You don't have to pay that loan back at all. If you read Nelson Nash, he recommends that as a good banker, you should come up with a plan. But let me tell you what I'm doing with it right now. I'm going to simplify. I said I've got these rental properties, which I do, but I'm going to the cash flow that they're bringing in is pretty small. If you've done the RP Capital, you got the turnkey rentals, a couple $100 a month. Like there's some cash flow, but then you have repairs, whatever. I really just view these right now as a tax sponge. This is going to help offset a lot of my tax burden. I'm not going to sell them, but right now, really what I'm focusing on is the low stress options. Of all of my assets, that's my highest rate of return right now. I'm at about 25% over the last 4 months on that. So is that going to continue? I don't know, but it's beating anything else I could do. So this is my priority. The rental properties. Oh yeah. Yeah.
Physical appearance.
my houses are a little bit, the roofs are sliding off a little bit. This is really my heavy hitter right now. This is where I want my capital to be focused. So right now, if I fast forward, I gave you that example of 1 year. I had $35K for my policy, but if we think about that, just to go back, I had 50 that I paid. 35 of that was the PUA premium, that bill cash value. I've had 4 of those so far, so that's about 140 in cash value. And then I've gotten dividends. Let's call it a dividends. Another. I mean, I'm making up numbers here, but let's say I have like 165K of cash value. That's probably ballpark what this policy's at right now. Well, what I like to do currently is I keep a buffer here. My current one is that my current loan balance is about 120K. I'm keeping a little bit of a buffer here because what if the rental properties have an issue? Like this, to me, my cash value, even though it itself is my savings and protection, I view this as my investment account effectively. This is the source of capital that funds all of these things, right? My wife has a policy as well, and her cash value is our emergency fund. I don't touch it. This is our runway. So right now, I tracking my numbers, I have 220 days of living expenses at our current burn rate saved into this policy. I'm going to try to get to a year. Once I get it to a year, maybe at that point, maybe I'll borrow some of it. But right now, I just don't touch this. To me, this is off limits. This is pure savings. This is protecting my family. And having this here, when we talk about protect is greater than save, is greater than grow, like that order of operations is if my investments just tank, like if these just burn down, if the roofs fall off, right? If this stops working, at the end of the day, this is still the cash value that's growing uninterrupted, but I do have this loan here. So I do have some interest income that I need to be coming up with. Now, I don't need to, that's not the precisely correct word, but in my mind, I at least want to be paying this interest. But right now, as it sits, these rental properties are doing a little bit, but mostly they're absorbing my tax bill. My emergency fund is off limits to me. That's my wife's cash value, but my cash value currently is making, that was 25% over 4 months. So that's really cranking. Now we're going into sliding in the market a bit. I'm going to conservatively say that I'm going to do 50% in this asset in year one. We'll see. Who knows? But right now, regardless, again, it's always compared to what is that sustainable? Doesn't seem like it. I don't know. I'm going to let it ride. But for now, this is my best performing asset. So this is where I want my capital to be. But I also want to do it in a way, again, that builds this wall here and cannot impact my savings or my protection. And so let's think through this. If I'm putting my money into the options trading here and I'm making really good returns of that, I do have this loan to the insurance company, and my current 120K loan is like 6K a year in interest, something like that. So I have a 6K in interest, but I'm making many, many times that here. So like, let's just say I have a 400% return. Maybe I'm making 3 times this much or 5 times this much, whatever the numbers are, right? But this is where I'm beating inflation. This is where I'm growing. This is my, future cash flow that I'm building up for when we, like to retirement, whatever we want to do, right? This is where the growth is happening over on this side of the ledger. But if I pay back this loan, and if I take the Nelson Nash approach of, well, if I would borrow the money from a bank and pay them at X schedule, I should pay at least that much to my bank. Well, if Chase Bank offered me a loan on these terms, no repayment schedule, all payments go strictly to principal, it compounds once a year, it's not amortized, and it's guaranteed without underwriting. If I had those terms from Chase Bank, I would treat it differently than the loans that they would currently give me. So if I choose to pay off this loan, what am I doing? Let's say I throw, this investment yields 10 grand and I want to throw it into my loan, right? And reduce my principal. So I throw 10 grand in here against my loan. Now my loan balance is 110, and I've increased my cash value available to borrow from, in this example, from 45 to now 55, right? Well, if I'm keeping 45 as a buffer, whatever this number is, then anything in here is not optimized if I can make more in this investment, right? Now, if this was my savings as well, I wouldn't treat it this way. But in my mind, what I'm currently doing is I'm paying 6 grand a year, or I'm paying this interest every once a month. I log in, whatever comes after the 120, say that's 312, whatever that number is, I pay that down. I'm keeping this as a principal only loan, or sorry, an interest only loan for myself right now by choice, because I'm the banker and I have control of that. And I would rather my dollars be working for me in the investments than sitting in here in my cash value, right? So it's, again, to answer that question, I don't have to pay back this loan at all. I don't even have to pay back the interest, but then it would start compounding once a year, and I don't want it to start compounding out of control. So I choose currently to pay this down to the principal every single month. You could do the same thing every single year, but that's how I approach this. I create this as an interest only environment for myself right now, so that I'm not so that I'm maximizing the opportunity in my most valuable asset apart from my human life value, which is currently in the options trading. Does that make sense?
Yeah, this is great. I think this is a great overview. We'll get the replay out to everybody. Guys, would you drop a link in again to your website, so if folks want to kind of explore these ideas more and maybe chat with you, they can do so, and we'll send this link out in the replay as well. We'll give you a couple minutes here. What haven't we talked about? Is there anything that we should cover before we sign off?
I'll say this: when you hear the IBC marketing, when you hear it on social media, there's people that really, really hate it, and I think that's because they don't understand it. But there's also people that are like, this is the only thing you need to do. All your dollars go in here. 100% of your income needs to go into this. You never deal with a bank again. That was the Nelson Nash approach. He called it the snakes and dragons. It takes 18 to 20 years for the average person to totally cut out the need and dependence on banks. I'm not as dogmatic myself. I view this as the most powerful tool I have, but not always the right one, right? And so an example I used in an episode that's coming out on Friday, if I need to hammer a nail, I'm not going to be pissed that my sandpaper can't do the job, or that my screwdriver does a poor job at hammering the nail. Like, different assets have different roles and things that you can do with them and different attributes. And so this is, to me, the most powerful tool that I do have, but it's not always the right one. For instance, we're buying a car coming up soon. Hopefully by March is the plan, but I could take out a policy loan to pay for that car. That way I don't burn my cash, like Dave Ramsey says. I also don't finance and pay money to a dealership where all the money goes to them. And at the end of it, I have a car and no cash. The most effective way in a vacuum would be, in my mind, to take out a policy loan. However, that example I just walked through, if I do that, now that's money that can't go into low stress options. It's not going to come out of my wife's policy because that's our emergency fund. If it comes out of my policy, yes, I acquired the car more effectively, but I did so at the cost of what could be generating much greater returns in my investment world on the growth side of the ledger. And so I'm probably not going to take a policy loan to get the car. Honestly, I'm probably going to finance with the dealer, because what I want is low monthly payments. Now, that would make someone like a Dave Ramsey fan explode, because they're just like, no debt, that's the worst thing ever. But in my mind, low monthly payments in a dollar devaluing environment, if I can lower my monthly payments because I have the discipline that those dollars that I'm saving relative to a higher monthly payment but lower total volume of interest, for instance, if you run all the numbers there, if I want to solely minimize the interest paid to the company, I would pay cash, or I would take the highest monthly payment. Like, we could do all those things, but at the end of the day, the more cash that I can conserve and keep today and put into higher growth assets, that's the route I want to go currently. But having the ability to go into the dealership and pay down the car in cash if I want to is a very powerful tool to have, though it's not the only tool. And so I'm not in the camp of I never ever want to do business with banks. I want to be in a position where I use the banks as my tool, not that I am their tool.
So I think that's a good point too. When the Dave Ramsey stuff, and by the way, everything he did was like from the 90s, right? Like nothing has ever been updated in the damn Dave Ramsey camp. If maybe I'm wrong about that, but that's my general thought. But it treats, and it's kind of mainstream finance is the same way. It treats the dollar as a static entity. The dollar is a dollar is a dollar is a dollar. And so Dave Ramsey says, well, you should not, like, the interest you pay is terrible. Like, don't pay any interest. And it assumes that the interest you pay today is the same as the interest you will pay 10 years from now. But the reality is, with the devaluating dollar, if you can fix an interest payment and over time, you know, your payment's actually cheaper 5 years from now than it is today, or whatever the numbers are. They don't have a complex nuance, a complex outlook on the monetary system when they make these simplistic recommendations to never pay interest. Because as you demonstrated today, if you can pay $1,500 in interest, but that loan generated $3,000 in income, well, that's 100% return. That's the best interest you'll ever pay, you know? And so you've got to be very nuanced and flexible, I think, with it.
Yeah, it's just, I just want to pick this apart. I was thinking about it yesterday. It's kind of funny on Dave Ramsey that, whoop, I put the wrong year in there on this inflation calculator. Hold on. His book, Financial Peace, came out in 1995. And he's been teaching to start a baby emergency fund of $1,000 ever since then. Yeah. And like, never, to his credit, I think people that need to get out of debt and have never saved a dollar in their life, like, he does great things for them. I think after you get to like start paying off debt, I wouldn't even do it the way he does it necessarily, but that's a whole nother conversation. But like, he's been telling people to save $1,000 now for 30 years. And so I just typed into this inflation calculator. Adjusted for inflation, it needs to be $2,112. Yeah. Like, he hasn't even adjusted that. Like, $1,000 baby emergency fund gets you, I don't know what that gets you through, almost nothing.
What, 4 boxes of diapers?
Yeah. And so he never accounts for the time value of money, for the motion of money, for the fact that if money's not moving, it's dying, like all those things. So he's got a great start for people that are really desperate to get out of debt and have really destroyed their financial lives. But that's it. He's got a good start. And it's helpful for those people. But yeah, it's all stagnant dollars. Like, it never factors in the time value of money.
Yeah.
It's frustrating because it's advice it's presented as if this is good for everyone, when in reality it's good for people that are broke and trying to get to even. Now, I know people that aren't broke who, if they, like, the opportunity cost of money, that conversation doesn't resonate with everyone, right? So if you said to someone, hey, you can save money, like if I told, you know, a lot of like, you say, hey, why would you pay off your house early? Because you're saving dollars down the road, but you're not changing your cash flow today. If you don't do that, you have more cash flow today. Like, you can take that cash and grow it and much outperform that. But if it's someone who doesn't do investments, if it's someone who doesn't have the understanding of like how they can do that, and the money's just going to sit there, or worse, just be spent, like, getting money out of your control so that it does something for you, even if it's not optimal by our standards. Like, there are people for whom that advice is very, very good.
Yeah, that's a great point.
You can't take that money and go turn it and make more than inflation. If you can't take that money and go make more today over what you're going to save when you pay them, you know, the 30th year of your mortgage, that's pennies on the dollars in today's dollars, right? But you're giving them dollars in full in $20, $55, right? You're giving that, you know, they would take, like, if you took the time value of money of your last mortgage payment, your 360th mortgage payment, you take that, like, $3,000, what is that worth today? The even exchange rate of that is probably like, what, $200 or something? You know, it's a very small number, right? Yeah. Is what that $3,000 in 30 years is worth today. It's worth not as much, right? Whatever that number is. But what you're doing is
half based on this inflation calculator, which could all change, but half at best. It's less than half. It's probably 47% or something.
And see, personally, I wouldn't give that up today. Like, I would rather have $1,500 today than $3,000 in 30 years. Like, to me, it's like, that is a very conservative estimate. But that even, I would say that someone who doesn't know what to do with that money and grow it more now probably should just tie it away, lock it up for 30 years, because that's better. And so it's advice for people that aren't at a very, like, financial checkers level. And if that's the case, like, they should not be doing what we're doing. And IBC is not for everyone. And not that this couldn't work for everyone. This is great for everyone, except personal behavior matters more than anything we talked about today. If you can't make that premium payment, and that's why we structure it to something that makes sense for you, if you can't make that premium payment, even though the best place these dollars can go, in my opinion, is into a policy first. If you can't get the dollars in there and you let the policy lapse or something, it's like not everyone we've talked to have we said, all right, it's time to move forward. Like there are things where we've said, hey, honestly, you just need Dave Ramsey. Like if you need rice and beans and your credit cards in a freezer, like that, if you need that, you need that. Most people here don't need that. Most people who do that are not paying out of pocket for the Phoenician League to be in a room with people with knowledge and experience and networking. Like those kind of people are typically not paying for an investment league, right? And so the tailoring that advice to who you're talking to is very important. Of course, when you have an enormous tens of millions of people listening to you, the idea that you could ever give blanket advice like whole life is always bad, or all the things that are said, it's like it's preposterous to even make that assumption that this is something that you can ever give like blanket advice. But
yeah. That's
all
a whole.
Is if you're in the Phoenician League, there's a good chance that you're trying to become wealthy. And my question is, do you know anybody that followed that plan, put in their money in their 401k, even if it's 15% or whatever, and left their income earning years better than they were doing in their income earning years? It's very few. It happens, but typically they also lived a 40-year life of scarcity to do that. The people who made it just on their income and just on their mutual funds, they also never enjoyed a single dollar today, or not. They very seldom enjoyed, they lived like a miser. So if you want to live your life now and you want to become wealthier and wealthier, I don't want to be in a lower tax bracket when I quote retire, because I don't plan to do that. But whenever I slow down, I don't want to be in a lower tax bracket. And the only way that I know to do that is to keep money in motion. Yeah. It has to flow. And we just think and we think it's all about environment. We believe that whole life insurance is the best environment to warehouse that money and to flow it from and back to. So it's all about just where's your money flow from, where's it flow to, where's it flow through, and capturing that in the form of premium and whole life insurance and policy loans and policy loan repayments is the best method I've seen to go from zero to hero. As long as
it works.
Yeah, it works.
It works in practice. Yeah, Brian mentioned he bought land, which wasn't not even an investment in a monetary sense. It was more in a, generational family planning sense, peace of mind, lifestyle, all those things, I should say. I've bought investment properties. I know Hans has bought investment properties. I think Hans is planning to acquire New Hampshire soon as well with IBC cash value.
When I take over and secede New Hampshire, there will be many changes.
But it works. It works in praxis. The only downside's not the right word, but the only thing is that it takes a little bit of time to get it going. It takes a little bit of time for the dollars that you put in to surpass, for the dollars that you, I guess, can get out to surpass the dollars that you put in. You've got to capitalize, is what Nelson Nash said. And that's where the discipline comes in, and the planning. But I know you guys are great with working with people to customize these policies so that it matches the situation. So I really appreciate everybody joining us tonight. We've been going for an hour and a half now, so it's probably a good place to leave it.
These folks have shown much patience and discipline, so you can do this.
Yeah, that's great.
Out there, we'd love to chat with you.
Yeah, the Remnant Finance team, these guys, they do great work. I know this is something that can fit with really, many different situations. Just talking with folks in the Phoenician League, we've got people in, all walks of life, all kinds of different situations. And the beautiful thing about this strategy is that it can be customized to accommodate whatever the situation is. But I know the great thing, you mentioned this already, but I know I've kind of referred a couple folks to you before who I think you kind of concluded that it's probably not the right fit for you right now. There's probably some things you need to do first before we can confidently put a strategic policy in place. So I know I really appreciate that you guys take the time to work with people on the specifics, and that you're willing to say, you know what, it's not the right time right now. Let's talk again, in 6 months or whatever the case is, when that's appropriate, because I think that's important, and I really appreciate the partnership with you guys, because I know we're on a mission in a sense. This isn't just this is just, it's not about maximizing business. It's about trying to get the message of financial education and working with people and all those things out there.
One thing we never want to do is make implementing the infinite banking concept feel like a burden to your financial life. It should be a blessing. And in the first place that should start is a place to save. Like I said earlier, savings equals premium. And if you're not capable if you don't have that positive cash flow in your life, you may have it in the form of like a small windfall, but if you don't have an ongoing savings habit, this will start to feel like a burden, because you're adding to something that you don't have the liquidity to do on a year-to-year basis. And I won't put somebody in that place just to earn a little bit of business. It's just not the right thing. It's gonna feel like weight on their shoulders. And honestly, like, it's a really, really weird thing, because everybody hates insurance, but I look forward to paying my premiums now. And I think most of our clients, a couple years deep, or if they have a really good understanding right off the bat, but once they see the power of implementing this system, they actually look forward to paying that premium. And that's the place I want you to be. If every year it's like a stressful event, then you're not ready, and I'll let you know that. Like, it's better to get you ready to go than it is to push you into something that is going to stress you out.
Yeah, I just paid I've got 2 policies on my daughter that I paid just this month. And the very next day, the first thing I do is go and check, all right, what's my cash value now? Because it's at the point where the cash value's now more than what I paid. And so I just made money. I gave the insurance company money, and I made money. I now have more money by doing that. It's just, it's such a cool thing. And it's so, I don't know of any other asset, any other place where that dynamic exists. Now, there's investments where you might be able to make a lot more money, but it's not guaranteed. You don't know. You're taking on risk. With this, it's, you don't have the same risk level. So just such a great thing. Lean on the Remnant Finance team. They're a great resource. They're willing to chat with you. They also have, I know you've got a lot of information on the website too. So really appreciate it. Thanks everybody for joining us. Guys, thank you very much for your time and doing a deep dive here. These are things that I know enough to be dangerous, but I don't have the ability to kind of explain it the way that you guys can. So it's probably best to leave it here. Any final words as we part?
I just want to thank Joe Withrow, number 63, for all the great comments, for filling people in and answering some questions.
I thought it was number 74.
Oh,
which one was it?
Sorry. I think it's AKA Jeremy. I really appreciate you chiming in there. I know you said you're an authorized practitioner, and it was super helpful to have you, if you're still on, backing us up while we're talking, because sometimes it's hard to catch those comments, and great explanations. Appreciate your help.
Yeah, for sure. Cheers, y'all.
Awesome. Well, thanks guys very much. Have a great evening and a great week.
All right. See you. Thanks for having us, man.
Yeah, man. Thank you.
Thanks for listening to Remnant Finance. If you found any value at all in this episode, please subscribe, leave a review, and share it with a friend.
Remember, true financial freedom comes from taking control of your personal economy and breaking free from the status quo. So stop being a passenger in your family's financial future.
Boldly take back control of your wealth. Until next time,
this is Brian and Hans signing off.